Welcome to Celebrity Investing, your go-to source for financial and investment information that can help you on your journey to wealth and success. This is part 2 of our video on what is an aggressive investment strategy. If you need professional advice, please seek a licensed financial advisor. Thank you for joining us, we appreciate that. Let's continue to talk about what is an aggressive investment strategy. Key metrics for evaluating performance. When evaluating the performance of an aggressive investment strategy, several key metrics can provide valuable information. These metrics include 1. Total return. Total return measures the overall change in the value of an investment, including both capital appreciation and any income generated through dividends or interest. It provides a comprehensive view of an investment's performance over a given period. 2. Annualized return. Annualized return calculates the average annual growth rate of an investment over a specific time frame. This metric offers a standardized way to assess performance, making it easier to compare different investment options. 3. Sharpe ratio. The Sharpe ratio measures the risk-adjusted return of an investment by considering its volatility. A higher Sharpe ratio indicates a better risk-adjusted return, signaling that an investment has generated more significant returns relative to the level of risk taken. Benchmarking. Benchmarking is a critical aspect of evaluating the performance of an aggressive investment strategy. By comparing the strategy's performance against a relevant benchmark, investors can assess whether the strategy has outperformed or lagged behind the market average. Common benchmarks used for different asset classes include stocks. The S&P 500 or the Dow Jones Industrial Average are often used as benchmarks to assess the performance of stock investments. Bonds. The Bloomberg Barclays U.S. Aggregate Bond Index serves as a common benchmark for fixed income investments. Mutual funds. Mutual funds can be compared to relevant index funds within the same asset class. By benchmarking, investors can gain insights into whether their aggressive investment strategy has been successful in generating superior returns compared to the broader market. Tracking returns and risk. To evaluate the performance of an aggressive investment strategy, it is crucial to track both returns and risk metrics over time. This ongoing monitoring allows investors to identify trends, assess the strategy's consistency, and make informed decisions. Some essential aspects to track include cumulative returns. Monitoring the cumulative returns over specific periods helps investors understand the overall performance of their strategy. Standard deviation. Standard deviation measures the volatility or risk associated with an investment. Tracking this metric helps investors assess whether the strategy's risk level aligns with their risk tolerance. Drawdowns. A drawdown represents the peak-to-trough decline during a specific period for an investment. Monitoring drawdowns helps investors understand the potential downside risk and how the strategy has performed during market downturns. By regularly tracking returns and risk metrics, investors can ensure their aggressive investment strategy remains aligned with their goals and risk appetite. In summary, evaluating the performance of an aggressive investment strategy requires analyzing key metrics, benchmarking against relevant indices, and tracking returns and risk. By carefully assessing these factors, investors can gain insights into the effectiveness of their approach and make informed decisions to optimize their investment outcomes. Determining if an aggressive investment strategy is suitable for you. When considering an investment strategy, it is important to assess whether an aggressive approach aligns with your financial goals and risk tolerance. This section will guide you through the essential factors to consider before adopting an aggressive investment strategy. Risk tolerance assessment. Before diving into aggressive investments, it is crucial to understand your risk tolerance level. Risk tolerance refers to your ability to withstand fluctuations and potential losses in the market. Here are a few points to consider when assessing your risk tolerance. 1. Investment experience. Evaluate your previous experiences with investments. Have you invested before, and if so, were you comfortable with the risks involved? 2. Financial goals. Consider the importance of your financial goals. Are you investing for short-term gains, or do you have a long-term investment horizon? 3. Emotional resilience. Reflect on how you handle market volatility. Are you easily stressed by fluctuations, or can you remain calm and focused on your long-term objectives? 4. Time to recover. Assess your time horizon for investments. Are you investing money that you may need in the near future, or do you have the ability to ride out potential downturns? By honestly evaluating these aspects, you can gain a better understanding of your risk tolerance and whether an aggressive investment strategy is a suitable choice. Time horizon consideration. Your time horizon is a critical factor when determining the suitability of an aggressive investment strategy. The time horizon refers to the length of time you plan to keep your investments before needing to withdraw funds. Here are some key points to consider. 1. Short-term goals. If you have short-term financial goals, such as purchasing a house or planning a wedding, an aggressive strategy might not be appropriate. Short-term goals usually require more stable and less volatile investments to protect your principal. 2. Long-term goals. On the other hand, if you have long-term financial goals like retirement planning, you may have more flexibility to adopt an aggressive investment strategy. Over the long run, aggressive investments have the potential to outperform more conservative options. It is crucial to align your time horizon with the aggressive investment strategy's inherent volatility. The longer your investment horizon, the more time you have to ride out potential market fluctuations. Financial goals alignment. Aligning your financial goals with an aggressive investment strategy is an important step in determining suitability. Consider the following points to ensure that an aggressive approach matches your objectives. 1. Growth objectives. Aggressive strategies are typically pursued by investors seeking high returns. If you have aggressive growth objectives, such as maximizing wealth accumulation or achieving financial independence, an aggressive strategy may align well with your goals. 2. Capital preservation. However, if your primary goal is capital preservation and minimizing risks, an aggressive strategy may not be the best fit. In such cases, a more conservative investment approach may be preferred. Reflecting on your financial goals and understanding the trade-offs between potential returns and risk will help you decide whether an aggressive investment strategy aligns with your aspirations. In conclusion, an aggressive investment strategy is a high-risk approach that aims to generate substantial returns in a short period of time. This strategy involves investing in asset classes with the potential for high volatility and growth, such as stocks, cryptocurrencies, and emerging markets. While an aggressive investment strategy can offer the possibility of significant gains, it also carries a higher level of risk compared to more conservative approaches. It is crucial for investors to thoroughly assess their risk tolerance and financial goals before adopting an aggressive strategy. Additionally, diversification and regular monitoring of investments are essential to mitigate potential losses. Ultimately, an aggressive investment strategy can be a viable option for individuals seeking to maximize their returns, but it requires careful consideration and a comprehensive understanding of the associated risks. Continue to watch our videos to gain valuable insights into the world of finance. Thank you for watching. We hope you got information that you had not received before. Please comment, subscribe, like, and share to continue your journey to financial success.